This video will help you avoid accidentally over-contributing to an employer-sponsored plan like a 401k or 403b, etc. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. While it's not as common as overfunding an IRA or Roth IRA, overfunding an employer-sponsored plan totally happens, and most of the time it happens with those who are running solo 401ks, self-employed folks. Now, those are the solo 401ks, for example, that our office doesn't manage for clients. However, it absolutely does happen, and in today's video, we'll touch on some proactive ways to avoid accidentally falling into IRS red zone territory and needing to make a correction. So let's jump in. And while our focus today is on employer-sponsored plans, 401ks, 403bs, etc., if you're curious to know ways to rectify and ways to avoid accidentally overfunding an IRA or Roth IRA, I'll link above to my previous video that breaks that down in more detail. Before we touch on the prevention methods, let's quickly touch on what should happen if you accidentally overcontribute to a retirement plan. Now, luckily, the third-party administrator and HR work hand in hand to solve this problem for you most of the time. However, in the spirit of trusting but verifying that they did things correctly, I'll break down what needs to happen. In addition, it's important to know this because if the IRS steps are not followed appropriately, then you're the one that gets hit with the tax penalties, not your third-party administrator nor HR. Philosophically, regardless of when you discover that you made a mistake, you need to withdraw the excess contribution plus the growth in the account attributable to that excess contribution. It's also called net income attributable. And I'll link above to an explainer video that breaks down how to do that math. Technically, the deadline to pull out money and not get hit with a bunch of tax penalties is April 15th in the calendar year following the calendar year in which you made the overcontribution. To clarify, it doesn't matter whether you're filing a tax extension or not, taking your tax deadline from April 15th to October 15th. While that does play a role in correcting IRA and Roth IRA overcontributions, it doesn't matter for the sake of employer-sponsored plan overcontributions. If you go to correct your mistake before April 15th, then you must withdraw the excess contribution plus the growth. And if it's a pre-tax salary deferral, you'll experience what the IRS calls double taxation. And that's where, if you're correcting your mistake before April 15th, your company will send you a corrected W-2 for the calendar year in which you made the overcontribution because you took a pre-tax deduction on funding the 401k, for example, and now you have to include that back into your compensation. So your corrected W-2 would show a higher number as far as compensation is concerned. In addition, in the calendar year in which you pulled the money out, which is generally going to be the next calendar year after you made the mistake, you get to then pay income taxes via a 1099-R that gets issued by the 401k company in the calendar year in which you took the money out. In addition, you have to pull out the net income attributable or growth. So it's your excess contribution gets taxed again if it's a pre-tax contribution. Then in the next calendar year, you have a 1099-R that'll show you pulled out a certain amount of money, which again is taxed as ordinary income. Plus the growth comes out in that next calendar year. Now, there's no 10% early withdrawal penalty tax applied if you correct your mistake before April 15th. And if your salary deferral was actually a Roth contribution, well, then there's no correction on your W-2, but you would owe income taxes in the calendar year in which that money is withdrawn. Plus, the net income attributable or growth is again taxable. So you wouldn't be double taxed on that contribution, but you'd be single taxed on Roth money that you already paid income taxes on in the previous calendar year. So in some ways you could argue it is double taxation, but I think you understand my point. Now, what if you missed the April 15th deadline? And again, it doesn't matter if you're doing a tax extension or not for yourself personally. The only thing that changes is in the calendar year in which the money is being distributed from the employer-sponsored plan, you still pay income taxes on the money withdrawn to include the excess plus the growth. However, given that it's after April 15th, you then get to pay a 10% early withdrawal penalty tax on the amount of money distributed in that calendar year. Now, the 10% early withdrawal stuff doesn't apply to Roth IRAs and IRAs when you are correcting overcontributions. That was done away with in the Secure Act legislation, but it still applies to employer-sponsored plans. So definitely April 15th is not a deadline you want to mess around with if you overcontributed to your employer-sponsored plan. Now let's touch on how we can avoid landing in this position in the first place ideally. And for that, I'll break these down into 3 categories. So category number 1, that's going to be when you've accidentally saved or contributed too much into your employer-sponsored plan. While most employer-sponsored plans are sophisticated enough where they'll shut off your contributions in the fall if you're on track to overcontribute, some plans don't. Now that's ultimately, in my opinion, a mistake of the third-party administrator for not catching this kind of stuff, but It could still happen. People are people and they make mistakes. Now, there are some exceptions with Amazon, for example, of larger companies that permit after-tax contributions. For a refresher on that, I'll link above to my previous video that I break that down a little bit more in detail, whereby you are allowed to contribute in the regular 401k, 23 grand or 30,500. Your company match goes in there as well, and then you're permitted to fund an after-tax 401k. And the after-tax 401k, basically like another Roth 401k, where you can put in another 30, 40 grand, for example. A lot of companies might just move your over-contributions to the 401k into that slot so that you end up not accidentally over-contributing. But again, it's something you'll need to know about with your specific situation. The second main category is when your income dictates how much you can or can't fund into a 401k. Now, there's a common misconception out there that if your income's too high, you can't fund a Roth 401k. That's not true. You can make $1 billion a year and still fund a pre-tax or Roth or after-tax 401k. None of that matters. All those income limits apply to IRAs. In addition, it doesn't matter how much you put into an employer-sponsored plan. That doesn't affect how much you can then go put into an IRA. Theoretically, you can do both, one or the other. It depends on your situation. But if you make $1 billion a year, you could still theoretically max out a 401k and an IRA. You would just have to fund that IRA in a non-deductible IRA fashion. Now, I mostly ever see this as a problem with those who are running solo 401ks or solo employer-sponsored plans. And that's because you're in more control. It also means you come with far more liability. The problem here might be, for example, let's say you've got a massive amount of savings in the business bank account, but payroll's really low or revenue wasn't really high this year. However, you somehow manufacture maxing the solo 401k at 23 grand plus a massive profit share. Well, unfortunately, if your salary or your net compensation wasn't high enough to justify how much you're putting into the 401k plan, well then by definition, you're in overcontribution territory. You didn't have enough earned income to justify how much you are putting into the plan. For solo 401ks, you're allowed to electively defer 100% of your compensation not to exceed that $23,000 or $30,500 number. Compensation for self-employed folks is defined as earned income, which for self-employed folks is defined as your compensation minus half of your self-employment taxes. If you're a single member LLC or whatever and you file a Schedule C, then you would look at line 31 and then minus half of your self-employment taxes to figure out your total compensation. And if you're an S Corp, you look at your 1040 line 1A, you'd probably see a salary number, and that's your W-2, which is your compensation. You're maxed out at funding your 401k at 100% as a salary deferral, 100% of your compensation, not to exceed that $23,000 or $30,500 number. If you run a solo 401k, you'll know that you'll also have access to a profit share section on the 401k plan, and that's limited to 25% of your employee's compensation. And if you're the only employed, then that's 25% of your compensation. Using the previous math to figure out how much you made in compensation, then that's where you dictate how much the profit share went in. Now, of course, that's a very easy way to accidentally over-contribute, is if you put in more than 25% of your employee's compensation. The third main category of person that accidentally over-contributes to an employer-sponsored plan is for those who are looking to do IRA to 401k rollovers or 401k to 401k rollovers. What that would look like is if you are in RMD territory based on your age and you're looking to move an IRA that's been subject to required minimum distributions into a 401k at maybe a company you're still working at, for example, then when you look to do that rollover, if you don't pull out the required minimum distribution, then you'll have over-contributed to that 401k by way of a rollover because you have to take out the required minimum distribution. You can't roll that into a new plan and forget about the RMD. In addition, since the IRS looks at all your 401ks as different accounts, they don't aggregate them together. If you've aged into needing to take required minimum distributions, but you're still working at a company and therefore maybe deferring RMDs out of that 401k, that doesn't absolve your other 401ks from needing to take out an RMD. Once you're told that by your CPA or your advisor, if you look to quickly move all your 401ks into the new 401k so you can defer those RMDs in future years, that doesn't work. You have to pull out the RMD out of each old 401k you have, then you can move whatever's left over. But you have to take out the RMD once it's subject to an RMD. And this would be the same thing for pre-tax 401k RMDs and Roth 401ks. If you're trying to do a Roth conversion in your 401k using an in-plan Roth conversion to avoid needing to take out a required minimum distribution, you can't do that because you have to take out the RMD once you're told you have to take out the RMD. Once you take out the RMD, then you can do some in-plan Roth conversions, sure, but only on whatever's left over. You can't do it before you take out the RMD. And if you're unfamiliar, If you currently are employed still, but you've aged into RMD territory, you're allowed to avoid taking RMDs out of your current employer-sponsored plan at the employer you still work at, as long as you're not more than a 5% owner in the company. So from a calls to action standpoint, if you think you might fall into one of these categories, particularly for my self-employed folks, I'd highly recommend you have a lot of due diligence around making sure you have somebody else audit how much you're putting into your plan. It would absolutely be frustrating to get a virtual knock on the door or get a letter from the IRS in your mailbox that says, hey, you are in overcontribution territory, we did some testing, yada yada, you now need to take out a bunch of money and pay a bunch in taxes. I'll link down below to some IRS articles that break down what I was talking about a little bit if you want to do some more reading. Other than that though, I hope this was helpful. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your week. We'll talk to you later. Bye.